Welcome to Money Discourse. Coming up, CPI in line with expectations, Tesla slashing prices, the German auto industry in turmoil, and volatility following major bank earnings. Rajan, why don't you take it away?
Yeah, to be honest, in general, it was a pretty good week last week. It sort of felt like a bit like the end of the bull market last time. We had a good rise pretty much overall along most of the industries. We had a meme mania. We had GameStop, BedBath and Beyond. They announced bankruptcy. They filed for bankruptcy. Shares went down to like $1.50 and then went to a high of $5 following the bankruptcy. So that's like a 300% gain there before retreating a bit. You had GameStop. I actually had a position in this one. Ended up taking a loss, and then in the last 2 days, pretty much rallied back above $20, which was annoying because that would have been a decent winner if I held on. But anyway, that didn't happen. You had AMC rallying, you've got crypto rallying, you've got Bitcoin above 21,000, having been around 17,000 at the beginning of the week. So we literally had a $4,000 rally in Bitcoin. You had some of these altcoins also rallying. So it's sort of given that vibe that it's a lot of these growth names, this tech names, they're all starting to have that run again as the market is sort of interpreting this CPI as the Fed has gotten control and that they're going to slow down. And pretty much the market is pricing in a 25 basis point hike. It's quite funny, like what the Fed is actually saying and what the market is pricing is totally different. The Fed is talking about going above 5%. The market don't see it like that way. And in fact, they see them cutting towards the end of the year, whereas the Fed is saying they're not going to cut rates at all this year. In fact, they'll only look at it next year. So where the market is and what the Fed is saying is different, but generally the market's always right. So it'll be interesting to see what happens on that. But we did get that CPI number. That CPI number came in line. The headline was expected to fall from 7.1 to 6.5%, and that's exactly what it did. And then we had a lot of volatility around the number, but we were down initially on the number, and then we went back up again. The core was also in line, which was a positive too. And so we went down, and then the market sort of pretty much made it all back up again during the session. But we still had that volatility with the inline number. So I can't even imagine what would have happened if it was either side of that number, the expectations. But overall, it's a good number, 6.5. And I said in the last pod that I think we're going to go down to the 2 handle pretty soon. And although a lot of people don't think that's a possibility, I still think it is, especially now Elon has, Tesla have cut prices by 6 to 20% across its range, which is going to obviously have to have a cascading effect on other EVs. I don't know how much it's going to do with the ICE cars, but in general, EVs were massively overpriced, and now it's bringing it back in line to probably where it should be. But we'll talk about that later. But in terms of, let's just look at what the S&P has done. So you can see that pretty much from the middle of December till January the 10th, we've actually been basing. There's been a very, you can see there's support and resistance. We've been basing really nicely. And then then we had that big breakout bar over here back on January the 6th, which broke out of this narrow range. And then we've just gone pretty much upwards since then. And what's been positive is that even if we've ended the day, or we've been in the day lower, the buyers have always come in towards the end of the session, and we pretty much ended up near highs in more or less all the sessions that we've had this week. So you can see this session last week, we closed at the highs. This one was a bit of a down day, but this bar on the 10th, we closed at the highs on the 11th and 12th and 13th. Each day we had the volatility during the day, and then during the end of the day, the markets rallied and we pretty much closed on the high. So we can definitely see that buyers are coming in right now. How long it'll last for, I don't know, but to be honest, this is a great start. And this is, for me, just trying to take bits off the table. That's what I'm doing. Similar sort of pattern in crypto, where we're at 21,000 on Bitcoin. We've had the crypto stocks just going wild. Coinbase was 31, now it's like almost 50. So we've had like almost 60% rise in Coinbase, Mara. All of these crypto related stocks have all just gone high through the roof. This is Bitcoin. Look at that. So we were trading around 17,000, and then we've just had this parabolic rise back to like 21,000. And bear in mind, we haven't actually been at 21,000 since the beginning of November. So we've come back towards that November high. And I think this is when FTX happened? Must have been, right? Beginning of November. So this is the FTX related fall, and we pretty much made it all the way back, and on decent volume as well. So got crypto back towards those levels. Let's just see if it breaks up below it. But in general, it's been pretty good for the crypto and risk on stocks. If we look at the S&P 500 heat map, you can see over the past week, we've had big tech led by Amazon actually having a good week, up 14%. Amazon from an 81 low, we got to we're trading at just below 100. So we've risen 14% in Amazon, 5.5% in Google. Tesla's been up 8%. We're back at 122. Microsoft, which was below 220, back up towards 240. So that's a 6% rise. Apple up 4%. And you can see energy, banks, they had all their earnings. Banks have had a strong session with this rising interest rates. And just in general, healthcare is probably the only sector that hasn't had the best of weeks, where we had AbbVie down 7%, Pfizer down 6%. But energy, utilities, basic materials, they've all had a pretty strong gain this week. So overall, it has been a positive week for sure. But again, like the big news on Friday, I think, was that drop in prices for Tesla. It's going to coincide with this deflation, in fact, and it's going to see more of a fall in these used car prices. So, I mean, is Tesla doing the work for the Fed for them? I mean, we've seen now used Teslas going for in the 20,000 range for a Model 3, which is insane. You would have never thought that. It's just insane. I mean, you know, like all these other manufacturers, especially the EV prices, they're going to all have to follow suit. And the problem is with them cars is that you just got to wait too long for it. Like, I mean, but forget about the margin in that. I still think that I just like my car so much that I would go for that same car again, even with the current dynamics, but I wouldn't wait 11 months for it again, knowing that I can get one for the same price in a month. And that, you know, that's what I think is the biggest advantage Tesla's got. So being the resident Tesla expert, what's your take on all of this?
Yeah, well, you know, it's massive price cuts when you look at it. It's not, you know, Tesla could have taken the approach of, you know, okay, the prices are a bit high, let's lower them by a couple of percent, and, you know, see what the demand is and kind of gradually lower it that way. However, they decided to just literally go gung-ho, cut prices up to 20%. The competitors, they're just probably thinking right now, man, what we're going to do, because pretty much all of them are losing money on their EVs. And with the cuts, it brings the Model Y down from 65,000 down to like 52,990. One good thing is you can actually add on the full self-driving package, and that's not included in the eligibility for the $7,500 tax credit. And also on the other side, Tesla also are going to be getting around $3,700 per vehicle sold as a battery credit as well. So this is actually really bullish for Tesla, but really concerning for pretty much everyone else in the EV game. If you look at Tesla's inventory, it's actually come down quite a lot. It's actually halved in the first 2 days after the price cut, which is great. But we've been seeing a trend in terms of EVs actually making up 10% of all new cars sold last year. So China, Europe, you know, really driving the market, and we've actually come to a state where 7.8 million cars, which is an increase of 68% year on year. And when you look at this in the market for EVs, like you were saying, used car prices are coming down a lot. And now having a good supply of used vehicles, and yeah, like you said, bringing the Model 3 down into the 20,000 mark, you know, even in the UK here, we're seeing them in the £20,000 mark, you know, standard range Model 3s at that price. That's phenomenal for adoption of EVs, because the secondhand market is obviously quite important as well.
It's really shaking things up, but if you look at it on a raw perspective, Tesla basically just put back the price to where it was in 2019, a bit higher than what it is. And the thing is that I would think it's bad for management if they really thought that these prices were going to stay this high for that long, and if that's what they were basing their whole assumption on. So I'll be shocked if they half didn't expect this. I guess it's just the rate, how fast it happens. But what I would, you know, it's quite crazy because how much of an immediate impact it's going to have it instantly. Because, you know, I was thinking that Elon keeps on talking about the Fed is raising rates too much. He's doing this. He's always been quite adamant that by raising rates too much is really going to kill the economy. But that's what the Fed actually want. They want to kill it and to bring inflation down. But he's doing his part for the whole for the used car prices. And if we actually look at actually the latest CPI breakdown, so still we saw energy services, still electricity and gas still making up the predominant part. Fuel oil is up 41%, but you can see that new vehicle prices are up 5.9% and used vehicle prices are down 8.8%. That is on a year-on-year basis, and used prices were down 2.5% in December, and new vehicle prices were pretty much flat. So just with this move that Tesla have done, you could expect there to be a big, massive change in these numbers on the January CPI print, because just in used car prices alone, CarMax announced just the day after that Tesla announced price cuts, they slashed all their used car inventory by around $14,000 and pretty much CarMax sold 57% of its Tesla inventory the last 24 hours. Now, I don't blame these type of companies, because the last thing you want is a whole bunch of inventory that has been devalued so much. You want to get it off your books as quick as possible, and you don't want it to be sitting on a lot. And so they did it, and then they're going through their inventory really quick. And I think that's quite astute from a company like CarMax. But Carvana have still got cars used with 10, 15,000 miles on the clock that are selling for 15,000 more, and you can get a brand new one. So some companies are still asleep at the wheel, but CarMax have come out, they're getting rid of that inventory, and so then they got it raw, and then whenever whoever's trading a new Tesla or any new EV or something like that, now it's going to be recalibrated to the new price, and so at least they can run it dry. But just alone looking at the used car prices here, you're looking at eBay Motors, you're looking at Craigslist, you're looking at just any listing place for a lot of these used car prices. Especially if you look at EVs, they've all come down so much. Yeah. So again, that's going to have a big impact on this CPI number for next month and into February. And bear in mind, the used car peak prices were some point in the middle of last year was the peak. So you're pretty much doing year on year with the peak coming up to last year. So you're going to see a massive downward drag on the CPI number. So again, this is Elon. Again, there's a whole number of reasons why I think he's done this. This is going to definitely help inflation, but also you can't produce the amount of Teslas that they're looking to produce and sell them all at the price that they had it at. And the thing is that he had to bring it into line with what people can afford. At the end of the day, the economy is sluggish. You've got 4 or 5% interest rates, 6% interest rates. And the thing is that they need to do what they need to do to try to not be stuck with a whole bunch of inventory. So now you can see with used CarMax, they're cycling through that inventory. And so for Tesla too, the amount they can produce and the amount they sell, that, just simple economics, supply and demand. They had to get that price where demand will meet it. And so we'll see how that actually plays out into their Q1 numbers. But, they had to do what they had to do.
Most people are now following this car dealership guy. They're saying that, it could be the harbinger that starts the consumer credit meltdown, expecting downward pressure on car prices. But it really depends. They've been harping on about this auto loan delinquency rates going to cause a massive crash in the markets, but it's never actually happened. So
can you imagine the amount of negative equity in these, like, who's got gap insurance? That's what they need right now, because I'm telling you, right, the amount I can't remember if we mentioned it in the last pod that 15 to 20% of car payments for December car sales were over $1,000 a month, right? And the amount of people paying $1,000 plus a month on all of these cars at these really high interest rates, and now with this Tesla price cut and the potential impact on all these other car prices, the amount of negative equity. And again, our attitudes have sort of shifted for car prices over the last 2 years, because we've sort of thought of it more as a commodity, but really it's now going to start to act like it used to do. You buy a new car, as soon as you take it off the lot, it's depreciated 20%, 25%. And this is pretty much coming back to where we were prior to this whole pandemic. And I've been saying to you before, this was the last bubble to fall, these extra inflated car prices, especially on the EV front. And now we're getting that. And again, as long as these people have got the money to pay it, that's fine. But the negative equity, it's going to be real. There's a lot
definitely.
of
you must be really upset if you got a Tesla in the last month or two. However, if you got it in the last few weeks of December, you would have had that 7,500 credit from Tesla directly, so the hit wouldn't be as bad. But if you look at some of these drops, like $13,000 drop for the Model Y and the Model Y Performance, and especially with the Model Y and the Model 3s, getting them with an additional 7,500 tax credit, bringing the Model 3 back into the 36,900, getting that to a vehicle like that brand new, and I'm really glad that these used prices are coming down, normal market dynamic going back to how it should be, because it was just unsustainable. And getting supply back online, it's really good for the whole industry. Used cars shouldn't be selling for more than their new car prices.
I mean, if you took advantage of it, if you got it, you sold your car, you did that, fair play to you.
No, but if you did,
to be honest, I was lucky. I managed to sell my old car before I got this and my new car, and I managed to end up getting, I just timed it perfectly. That was my best trade last year.
We're both in the market now to see if we can get some,
because I am looking looking for a second car, hopefully in the summer. And now, I feel like the opportunities are great. Like this is exactly what I was anticipating. I did not anticipate it to happen this fast. I thought it would be more gradual coming up to the summer, But I mean, this has really just brought that whole thing much closer. So
I would definitely say though, I think the car prices, the drops have been a bit severe, like you were talking about with CarMax and people just trying to liquidate their inventory. But I think things are actually going to get to some kind of equilibrium sometime soon. I don't see Tesla.
You were saying it's quite similar to just after the pandemic, where
exactly.
everything just went nuts, and then
everything went nuts. Yeah, you're right. Yeah, everything did go nuts, and there were fire sales on huge amount of inventory that used car dealers and new car dealers wanted to shift, knowing that we would all be in lockdown. But then everything kind of normalized as soon as things settled.
You have to get back the mentality of what buying a car is. It's a depreciation asset. You don't buy a car as an asset. But the thing is, it's not just car prices, it's stock prices. Pretty much everything over the past 2 years has totally shifted the balance of our thought and made us think that things were different, but really they're not. Everything's mean reverting. It's all going back to the way it should be at the end.
Look, we have to kind of roll this into a picture of increased interest rates, slow down demand for pretty much all vehicles. And when we just talk about the German market, they've been growing their pure EV share in the last year. And this is actually coming at the cost of total auto sales. VW's total auto sales are dropping year on year since 2019, where they sold almost 11 million vehicles to just over 8 million vehicles in 2022. And in 2022, they had 575,000 of those being battery electric vehicles. But also, when you compare it to other automakers, VW are actually shrinking in total ICE sales. And the problem is that the BEV increases aren't making up for the 3 million vehicle car loss that VW have had since 2019. So this is obviously increasing their costs as well, because less vehicles made means lower economies of scale. One of the most worrying things is that VW sales have shrunk 9% in China. They've even stopped shipping ID4s with heat pumps, which is like a big thing. I mean, like, who's going to want to buy a vehicle which is got lower range than it would normally have? We've seen in the past Tesla kind of, removing a few parts because of semiconductor shortages, like the passenger lumbar support or something like that, but not something that really would affect range like this. They've actually had a lot of software problems themselves. And, the CEO is talking about the MEB platform software won't be properly ready until 2026 or 2027 or later. And the entire German auto industry, that's like VW, Audi, Skoda, BMW, Mercedes, Porsche, etc., their combined EV sales is just the same as BYD today, right? And BYD's sales are actually growing at a faster rate than the whole German auto industry. So with this acceleration, you can't just say, oh, they're just going to take over next year. The problem is their planned capacity is just not enough compared to what BYD is doing. Forget Tesla. Tesla's in a league of their own. But this is really concerning for the Germans, because right now BYD is primarily in China, but what happens when they come to Europe and the States? It's really concerning. And like legacy automakers that have actually pinned their EV hopes on just one model are really hurting. So like if you look at, like, say, Jaguar, they have the I-Pace and the Porsche Taycan. Both their sales are down 16% year on year. And the thing is, these brands don't have another model coming out until I think it's 2025 realistically for both of them. So things are actually looking really, really bad for the German industry, because that is such a significant part of their economy. So what do you think?
Yeah, I mean, you know what it is it's the last drop to fall is now like these energy prices, which are already in the actual real market dropping like flies. Nat gas, it's just cratering. Oil, all below $3 a barrel in New Jersey. All we need now is the utility companies to pass that on to it, because I know in the UK, even though UK nat gas is now the lowest level in over a year, the prices just keep on going up. Right. So it's just like
my kilowatt hour prices for electricity just went up 5 pence a kilowatt hour. Now it's 35 pence.
Yeah, I know. Even though the market is clearing, it's freaking nuts,
it's insane.
It's just mental. But you can see that's the last. I mean, I think over here it's actually been. Even though the nat gas prices here, the actual gas prices here is up about 20%, just because it's been such a milder January that the usage of heat is actually fallen so much relative to a normal January that it's offset the price increase. So it's actually the same as what you would have had last year anyway. And I think next year, when everything gets restocked, all the nat gas get restocked, that's when it should come back to an equilibrium price. But unfortunately, in Europe, they're going to have to just face these higher bills for this winter until things, running. But I mean,
what are you doing? What are you doing? Are you going to Bed Bath and Beyond and stocking up on their clearance items?
I love Bed Bath and Beyond. I don't end up buying anything from there. That's my problem, So
the thing is that, when you're talking about that they rallied to, $5, investors thinking that it's going to be a copy of what happened with Hertz when they filed for bankruptcy. The key difference here is in 2020, when they did file for bankruptcy, Hertz had assets, i.e. their cars, that were appreciating in value at that time. They were increasing value. So there were lots of companies that were willing to bid on those at higher prices that kind of got them back in the game. Whilst Bed Bath and Beyond, their inventory is just deflating. Like a lot of these retailers, it's worth a much less. So to be honest, I would, if you can play for a very, very short term, that's fine.
Yeah, like Bed Bath and Beyond is no way anything of a long-term fundamental play. You are literally, I mean, one of the trades that I was trying to do when Bed Bath went from 1.5 to 5, I was trying to find a short play that made sense. But there's just nothing I can do where the risk reward made sense for me, because last year it was frustrating as hell that I was short around 10 and 15, and that's when it had that whole move up to 25, 28. And the thing is, I knew it was going to come down, but again, I was just taking too much pain. I eventually scratched and made a little bit of profit on it. And then next thing you know, it's at 1. And it just, you know what's going to happen, but it's just even at 5, you don't know if they're going to meme it out the roof and up to 10 or to 12. And you want to find a play that sort of where you can have a good risk to reward profile, because it's always dangerous shorting those when the market starts getting a bit memeified or whatever the word is, because you're seeing it in a lot of these names. Like I said, it seems to be a high growth bonanza right now, some of the moves that are happening in these stocks. And so you don't know how long it's going to last for before it gets back into its place. But
and it's always like that when you know an outcome, there's always uncertainties to happen. Like we knew Nicola was a fraud back then, and we absolutely got burned trying to short it. Just and it did come out to it was just the time frame was just wrong. That's the problem. Knowing when the market will let it die, and that took a lot longer. Oh well, this is the market for you. It's burned us, especially in 2022. Woo, what a roasting! But hopefully this year.
I mean, 2023 is started off
right.
Yeah, I mean, let's put it this way: 2023 is last year. The first day of January was the market high. This year, it's been different to that. So I think again we're going to get a lot of chop, but I don't think we're going to get that same type of move down. But is the bond market right? Well, that will really dictate where these markets go. But I mean, now you're seeing.
Is the Fed going to listen to the bond market? When Liz Truss, she got fired, they had to listen to the bond market. Now, will the Fed have to listen? This is the whole thing. Will they dig their heels?
This is what I think is going to happen. If you listen to their talk, there were a lot of them talking last week, and the whole thing is they don't want to, you've got certain members saying they're going to be data dependent, but they don't want to make the same type of mistake as what they did in the 70s, where they're too reactive every time. Oh, it's going down, let's now cut rates. Oh, it's going back up, let's do it. They want to stay a course, then let that run and then go down. So they don't want to be too influenced by, they want to see a sustained run of falling inflation and getting to where it needs to be, because still at 6.5%, it is way too high. But you can see where it's coming as the comparables, as I mentioned many times before. As we go through 2023, those comparables are going to come easier and easier, which will really bring down that number. But I think the Fed, to not lose any credibility, they're going to stick with their course, but they're not going to go, in my opinion, way. But I think now they can do it in smaller increments, 25 basis points. I mean, the next rate decision, they're saying 50 or 25. My money's on 25. But, the hawkish camp still has 50, but I don't see any reason why they should do 50, because I don't see 50 having any additional benefit to 25. You'd rather do a 25 and another 25 and a 25 if they want to, just see how the economy is rolling, rather than doing a 50 and a 25 and a hold. But the other way, they're saying that they don't want to go beat around the bush, get to their terminal rate as quick as possible, and then just hold and let it stay there. So there's two different camps about the way they're approaching it. I would have thought 25 would be better, but
I think they do 25 and then they'll stop. But it's only me thinking this because the Fed are irrational, and I tell you why. Because it was 2021 and they were like, "Oh, inflation's high. Oh, but it's transitory, right?" Like they weren't data dependent then, and now all of a sudden they're data dependent, and then they're very picky on what data they want to choose to be the factor that makes them at least pivot to not raising rates. But you can see the bond market is really pricing this in. And now what's happening with Biden? Is he going to be muzzled with these allegations that he's been taking confidential materials and all of that? Is this their way of taking him out for contention in the next general election? What's going to happen?
There's no way he's running for 2024. Like, I think what he's done what he was brought in to do. And pretty much now, as it gets closer to 24, they're just going to push him out. However, like all of a sudden, magically after all these years, he's got documents here. Going to probably find some other fields. They're all going to start popping up, all the stuff, and Biden will have no choice but not to run for 2024. So it's it's a game. Just big puppets are running the show right at the top, and
But what we care
Byron
about
Cott is one term and done.
but
there's absolutely no chance it's going to run again.
what we care about is, when are the Fed going to change their tune, and that's going to be the time to really put in any dry powder that you've got. But is it worth front running this, or is it just better to stay?
Well, let's put it this way: the front running is already happening, right? And it happens fast. I mean, if you look at some of these beaten down stocks, they have rallied a lot from the low. Like I've seen 200-300% gains this week on some beaten down stocks. So it's already happening, but I think there'll be plenty of opportunity to get in. Let's put it that way. So I don't think there's a moment where you need to go all in, all out. As I always say, scale in, scale out. And on these rallies, I'm selling. Yeah, I'm just selling at the end of the day. Like as soon as I've got some of my real dogs like down within a reasonable, where I should have had a stop in the first place, not when it's down 90%, but if it's down like 50% down, yeah, I'm out. just open, get me that cash. And I might be a bit too early. I might be totally wrong, but that I've got to have a strategy. I've got to have a plan, and that's my plan. But I mean, if we look at this week now, we're going to get a whole raft of earnings, which will really paint the picture of where the economy is at in terms of corporate level. We had a lot of these banks report, the major banks report earnings this week. We had JP Morgan, as usual, beating on the top and bottom line. Bank of America had a good EPS, but they missed on revenue. Wells Fargo was a EPS beat, but they missed on revenue too. I don't have I had Citigroup somewhere as well, but they again they missed. I actually have Citigroup on here. Did I tweet it? Oh yeah, there it was. They had $1.10, which missed the $1.18 estimate, but the revenue was slightly in line, pretty much in line. But again, all of these banks initially had mixed reaction to their data, and then pretty much ended up the week or higher. As as what's happening is that we now know that the Fed is slowing, but at the same time, we're in a high rate environment, which all benefit the banks massively. You've seen the net interest income, as you would expect, all rising. And so this has been a good underpinning for a lot of these banks. And we've had good rises for all of them, pretty much, especially like JP Morgan and companies like that. So this week now, we're going to have more earnings. We have Goldman Sachs, I believe, reporting tomorrow. Yep. Goldman Sachs and Morgan Stanley. Silvergate, we talked about that one last time, how we had huge capital outflows. They had that huge move lower. But it's basically this week, you're going to have a lot of these big banks and regional banks. And then next week, we're basically going to start getting the tech earnings. And that's going to be the real interesting ones to see how they're doing. Always, as usual, Netflix start the show. I think, is Netflix beginning doing it this week? Let me see. It's normally Thursday, the week before after the close, I believe. Yep. So Netflix are reporting 19th of Jan after close, expecting 7.82 billion and 45 cents estimate. So Netflix will be the first major tech name to report this week. And then next week, we're going to get your Googles, Amazon, Microsoft, Teslas. So next week will be the big one. And yeah, so that's where, let's just see where it all goes. It's going to be, I reckon we could see some huge moves again, as there has been every earnings for the last couple of quarters. But I guess it's always the guidance. I mean, you're going to have the read on the inflation. On the initial quarter, but what the guidance does, that's what we have to look out for. But again, it's the best time. We'll give you the most opportunities to get in and out. And let's just see. We had some huge moves I think last time Netflix had a massive move on their earnings. It was like 20% higher, 25% higher. So let's see what they do this time and see how it's going to be a good gauge for the overall tone for earnings season. So we'll see how it goes. Yeah, and don't forget, if you can, subscribe to the Twitter page, Money Discourse. A lot of good content, I think. Follow the portfolio as well for your own entertainment.
So if you like what you heard, please leave a comment and subscribe. It really means a lot to us.
And yeah, we'll catch you on the next one.